Greetings, savvy investors, and welcome back to the Dividend Uncle. Today, we're going to shed some light on the shadows surrounding Manulife US REIT. I've noticed a lot of chatter online about short selling and when to bail out, but we're here to focus on the long-term outlook. So let's cut through the noise and get to the heart of the matter. 1. Negotiations with banks. No news doesn't mean bad news. First, let's address the elephant in the room, the ongoing negotiations with the banks. Many have been on edge due to the lack of updates. But here's the scoop: these negotiations are running their natural course and have been productive so far. So no news doesn't equate to bad news. Here's a bit of insight into the process. There are about a dozen lenders, with a handful of lenders taking the lead by forming a steering committee to negotiate with the manager and the sponsor. They will then bring the term sheets to the rest of the lenders to obtain a consensus agreement. It's a proactive move, indicating a commitment to resolving the situation. Since the lenders have loans maturing at different times over the next few years, getting everyone to agree on a solution that aligns with everyone's interests is challenging. The conditions agreed upon must satisfy all the lenders. But here's the interesting part: the lenders' interests are somewhat aligned with unit holders. Lenders with a later debt maturity want to ensure that the REIT doesn't hastily offload its best assets, as it might hinder the REIT's operational performance and ability to repay the loans in the coming years. While the ultimate outcome remains uncertain, I'm cautiously optimistic. At this point, it is not just about obtaining a waiver for the breach, but a holistic package to provide the REIT flexibility and liquidity to ride it through the next couple years. As mentioned in previous videos, it is not in the bank's best interest to reject the REIT's request for a waiver of the loan covenant breach, as their priority would be to ensure that their loans will be repaid. 2. Sponsor support behind the scenes and ready to act. Alright, let's talk about the sponsor, Manulife. I get it, some of you might feel that Manulife, the sponsor, should have done more, and they should have done it sooner. But criticism aside, let's shift our focus to what's happening now. What are they doing to support the REIT? In a recent interview with The Edge, Mark Feliciano, Manulife's global head of real estate for private markets, representing the sponsor, expressed optimism about Manulife US REIT's future and the sponsor's commitment to help. I have provided a link to my previous video on this above if you're interested. Now, to demonstrate their commitment, Mark Feliciano was recently appointed as a non-independent and non-executive director to Must Sport. It's a step in the right direction, showcasing the sponsor's dedication. Critics might say talk is cheap, and they want to see action. Well, here's where it gets interesting. From what I've gathered, Mark Feliciano has been taking the lead in negotiations with the banks, indicating strong sponsor support. This might even signal to the banks that their broader banking relationships with Manulife could be affected by the negotiation outcome. So far, we know that possible sponsor support could range from either a proposed asset sale, we already know about the Phelps sale, or some form of sponsor financing, or a combination of both. Sponsor financing may or may not come with preferential terms, but it should help in some of the REIT's loan repayment and liquidity needs, although it won't decrease the gearing. 3. Reviewing the timeline, looking forward with confidence. Let's look ahead, folks. Here's a timeline of what to expect, so you can stop fretting about the lack of news. Negotiations with banks are expected to conclude by the end of the year. An extraordinary general meeting, EGM, will be held late this year or early next year to vote on the negotiation outcome. The REIT is actively seeking a disposition mandate for its non-core assets, so that it has flexibility to pursue the disposition of certain assets as long as the dispositions meet certain conditions, without the need to convene separate EGMs for unit holders' approval, which is essential for lowering gearing. As for equity fundraising, which may be inevitable, the manager needs clarity on the earlier few points before having a clearer idea of how much equity it has to raise to meet its mid- and long-term liquidity needs. The uncertainty might be nerve-wracking, but with a more proactive sponsor, a clear timeline in mind, and banks that have an interest in the REIT's survival, there's still hope. But don't get me wrong, the risks are definitely still there. Weakness in the U.S. office market, year-end revaluation which might give us another surprise, and risk of the REIT structure unwinding if distributions are not resumed. So dear friends, hang tight, stay informed, and remember, we're in this for the long run. Stay wise and stay invested. If you found this update helpful, don't forget to hit the like button, and be sure to subscribe for more insights. Thanks for tuning in, and I'll catch you in the next one.